All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer three fantastic listener questions we got. If you have any questions that are burning a hole in your mind about investing, please do not hesitate to reach out to us. We are here to help. And there are several ways that you can do that. We make it easy for you. You can follow on the show notes newsletter at einvestingforbeginners.com. That's an email directly to our inbox. So you can send a question that way. You can also send it to us on Spotify, on the app. When you're listening to our show on Spotify, you can ask us a question there. And you can also send them to us on the socials, particularly the X machine or LinkedIn. So with that, let's go ahead and dive in on the first question. So here we go. DNA or David Andrew, as a 50-year-old who has always wanted to know how to trade successfully for the long term and am now dipping a toe in, I need to know how to choose microcaps and know when to sell a stock once purchased. I've heard that I need to have an exit plan for each position, and I think that's smart. Knowing how to set those limits seems like an experience thing, but as a newbie, I would love guidance in that department. Thank you. And this is from Christopher. So great question, Christopher. And Andrew, would want to take a first stab at this?
Yeah. Well, thanks for writing, Christopher. Commend you for dipping a toe in. That is fantastic. And that is always the first and most important step. So congratulations. You've already made great progress. I know we say this a lot on the show, but it really does depend on your timeline. How long you own the stock depends on your timeline and what type of investor you are trying to be. So in my world, after kind of experimenting between being kind of more of a deep value guy who's very active versus somebody who buys something and lets them run for the long term, I found that having an ideal holding period of 10 years it works for me. And I like to have that as a frame of reference. The ideal situation is always you buy Coca-Cola in 1921 and you hold it until 1999 and it returns ridiculous returns for you. Obviously, that's the ideal. That's not always realistic. But 10 years, I think, is a good realistic goal if you're investing the way I like to invest and Dave likes to invest, which is holding something for the long term and it's a good business. The great thing about your time horizon is the longer it is in general over history has shown, the more greater chance you have at making money. So some really bad times to buy stocks would have been like 1999 or 2007, where depending on which stocks you bought, even if you held it for 10 years, you might have still lost money. But those time periods are more anomalies than they are your experience if you bought in 2010 or 11 or 12 or 13. It all depends on when you buy. So we have to remember it's a long-term game. We are playing this for the long term. I like to have 10 years as a ending point goal. And so when I look at a stock, no matter if I'm looking at something as big as Apple or as small as Crocs, I am looking and I'm trying to think 10 years ahead. Sometimes I try to look 20 years, but that's pretty optimistic. I think the future is pretty uncertain. But 10 years to start, I think, helps me put some of the decision making in context. And I think that can help a lot with the exit strategy.
Yeah, for sure. Do you think we don't play in the microcap sandbox much, if at all? Do you think having like the market cap size would have some bearing on not only how long you could hold the company, but also maybe what kind of air quote exit strategy you would have for that?
Yeah, micro caps are interesting. As a general rule, I think your outcomes are going to be different, a wider range of outcomes. So as a general rule, I think more micro caps crash and burn than if you were to buy a blue chip like a Microsoft, Apple, Google kind of thing. So yeah, that does kind of play into it. So it is a bit of a different strategy than what I am talking about because I buy mature cash generating businesses. And so to have a 10-year time horizon on that, the odds are stacked in my favor a little bit more. It's easier to invest in a business that is established and it's a leader and it's shown it can defend competition and it's done that for some time. So you say, okay, over the next 10 years, maybe it can continue to do that. So 10 years can be a good time frame for that. if you're in an industry where everything's brand new and the competitors are taking shots at each other every day, one day this competitor is ahead, the next day it's another competitor. That's tough. And to be able to say, oh, I know this particular business is going to be the one to be the dominant player in 10 years, that's a lot harder. So
Mhm.
you do have to be careful about taking somebody else's strategy and trying to put your own spin on it, especially if you're a newbie, because those kinds of things can get you in trouble. Not to say it can't be done, but just to say probably be careful.
Mhm.
I'm curious what comes in your head as you read this great question from Christopher.
I mean, it is a fantastic question. And like Andrew said, I applaud you, Christopher, for jumping in and getting your toes wet because that's the only way you're going to learn. And the market, unfortunately, can be an expensive place to learn, but it's also arguably one of the better places to learn. You learn what you can tolerate and what you can't tolerate very quickly. In microcaps, I will admit is not an area that I'm super familiar with just because I haven't played in that sandbox as much. And the thing that I know about them are you can find some really great businesses. Our friend Ian Castle, who's been on the show, that's the only place he invests in. And Maj, we've had him on several times, and he's in what's the super micro cap, so even smaller than micro caps, and that's how he's made his bread and butter. So there's definitely a way to play in that sandbox. It's just not something I've done. Now, from what little I understand about the microcap space, it feels like if you're looking for the next 10, 20, 30, 50 bagger kind of thing, that's the sandbox you need to play in. To think about Amazon, becoming a 100 bagger at the stage they're at now, that's the law of large numbers is going to make that a challenge, shall we say. But you mentioned this earlier. I think that's something to kind of maybe double down a little bit on is that the range of outcomes in the microcap land is probably greater than it is in mid cap to large cap companies. And you can see amazing gains and you can also see probably a lot more zeros than you do in, as Andrew said, blue chips. So that's something that is not to be taken lightly in that it really has an impact on how you invest. Peter Lynch said the most important organ in investing is not the brain, it's your stomach. And that is so true. And I think it's even more true if you're working in microcaps because there's either a lot of liquidity in those names or there's not much at all, which is even more of a harder place to be because if things go south, you don't have a lot of people willing to bid to buy it from you. And so you might have to just ride it all the way to the bottom. And that can be hard. It doesn't mean that it's impossible, but it's certainly something to consider. And so whenever you're investing in any style or method, I think the thing you need to figure out is what kind of investor do you really want to be? And as Andrew was talking about too, you also want to think about your time horizon. If you have a shorter time horizon, then maybe microcaps aren't the thing you want to play in. And if you are young and you have a long runway ahead of you, then maybe microcaps would be a great place to start. But I think I guess I don't necessarily think about an exit plan per se when I'm investing. Is that something that you think about much?
Yeah, well, because I'm a pessimist. That's always like, how can this blow up in my
Yeah,
face, right?
right.
Um, you bring up a good point with the liquidity, though.
Mm,
If a company like Apple or Target, these big names, if they stumble and they have a liquidity crunch,
mm,
not saying it's a magic bullet, but a lot of times if they're a bigger name, they've been around for a long time, it's easier for them to weather liquidity problems because of their name and their size and all the resources they have.
mhm,
Versus if you're a micro cap, that margin for error can be so slim that
mhm.
you might run into issues and there's nobody coming to save you. So
Right.
when you talk about exit strategy or exit ideas, I think that is like, what's the worst thing that can happen? And recognizing if you're going to play micro caps, there's a higher
Mhm,
rate of failure, I think is a good one. And yeah, I think the other one too is what's the upside? What are we hoping for? You made a great point about like investing in Amazon. You're not going to get 100 bagger from Amazon. When I have bought Apple in the past, very well knowing that okay, this probably won't 100x from here. what does success look like for me? Is it 11% returns? Is it 10% annually? Trying to like at least think about that can sometimes help understand what am I betting on.
Hmm.
So maybe I'm betting on the company to grow, let's say, just to throw out random numbers like 7% revenue growth and 10% earnings per share growth. And then I get a 1% from the dividend. So I got 11% return, right? Like those kinds of calculations I think are helpful because if you're just saying, I'm going to invest in AMC and they're going to be the next Netflix, there's not a lot of hard thought going into that. But maybe if you're like, oh, for AMC to become Netflix, they need to grow at 90% a year for the next 15 years. And you're like, oh, maybe that's not realistic, right? So I do like thinking about the end game. I do think that there can be a lot of regulating yourself, checking to make sure your assumptions are good. But that's all they are at the end of the day. They are
Mm.
assumptions. So I can think whatever I want about Apple's future or Google's future, but what's going to play out, it's going to play out. And that's why being diversified is also important because we're not going to
Mhm.
get them all right.
Yes.
And we don't know what 10 years from now will hold. So you just do the best you can. And hopefully you're not overthinking it, Christopher. Hopefully you're taking enough risks to feel like you're still dipping your toes in and you're still making progress. And I think that's probably most important out of all of it.
Mhm. Yep, I 100% agree.
Cool.
All right, so let's move on to the next question. So we have, hello, David Andrew. I have been forced to self invest for various reasons. And after listening to your podcast, I am grateful that I am now. I have been listening to the archives, trying to catch up. I'm on episode 250. Wow, congrats. And want to thank you for the education you two have provided. I have gone through your initial email series and just started to tackle your ebook. I feel confident I can take control and that your many resources will help me do so. So I am 40 years old, started this process in 2025. He has 70% of his investments in LTH. He works there and 30% in a 401k. So his question is can I expect FDVV to yield the same average 8 to 10% return as the total market? And if I am okay with that average return, should I invest half of my high yield savings account into FDVV now while I figure out how to pick stocks, with the other half slowly dollar cost averaging into FDVV, which is a Fidelity fund every month? Per online compound calculator, if I DCA $2,500 a month over 25 years into the fund, assuming a 9% return, I would have $2.5 million to retire. But if I lump $100,000 in now and DCA the rest, is that having too much faith? It could give me an extra $1 million. Is that having too much faith in FDVV? This is a great question from Paul, and I'd love to hear your take on this.
Yeah, it is for sure awesome to get all those numbers. And obviously I just preached about thinking about the end in mind. So you've taken that next step and jumped into all these calculators, and I love that. I
Right.
love it. I love it. I
He's got
relate with
all
it.
the numbers behind his decision, doesn't he?
Yes. Um, however, as we are all experiencing in real time, the market can get kind of crazy. So this is a very interesting time to start looking into the investing and stock market process. One of the things Dave mentioned, what Peter Lynch very wisely said, it's more important that you have a good stomach versus heart. Stomach versus brain, I
Brain.
think it
Yeah.
was. Yeah. It is hard to hold stocks when things are going out of control. If you are very confident in your ability to just set it and forget it, and you're not going to look at it for the next 10, 15 years, then yeah, putting it all in at once mathematically will be the better solution. Said he works at LTH, Lifetime Fitness. I'm not a gym expert, obviously. I'm just a guy who tries to go to the gym as much as I can. I would imagine that there are people there who they know all about working out
Mm.
versus people who like know enough about working out but actually do the work. And so I think with investing, I think there's some element of that as well, where it's like conceptually you can understand everything, but until you get punched in the gut and have to watch thousands of dollars, tens of thousands of dollars, hundreds of thousands of dollars, depending what life stage you're in, evaporate overnight. There's not a lot of flight simulators that can help you go through that. So the benefit to dollar cost averaging it versus putting it all in at once is that you can look at these tariffs, you can look at the market volatility, and you're not getting an aneurysm from it.
Mhm.
Especially if you just started a few months ago and this is like, hey, I'm gonna cut my teeth in the stock market. Again, a very fun and interesting and exciting time to do it. But there is something to be said about peace of mind and maybe, I don't know, patience, long-term mindset. I hope it's not all just doom and gloom on the other side of the microphone there. I'm just trying to be realistic that when you're first starting out, everything's new and the numbers and calculations are all great, but the actual experience of investing can be a lot different than what
Mhm.
you might imagine.
Yeah.
I mean, like for you, Dave, has there been anything in the last we're recording this on April 10th. Yesterday, the market went up like 9% in a day. Like, what was that like? Because we've been doing this a while.
Right. It was, well, truthfully, I didn't even know.
Yeah.
I talk all the time about like ignoring social media, ignoring the news and all this stuff. And we were talking about, off air about the tariffs and some of that stuff. And then you made a comment later in the day, like shortest bear market ever. And I remember sitting there thinking, I don't even know where I go to even check what's happening in the markets because I don't do it. And I was like,
Yeah.
oh, I'll just log into my account. And then so I logged into my Fidelity account and like the market's up 10% today. What the heck? And, I don't know what it was down the day before because I didn't pay attention. I just knew based on the tweets that I had seen that, everybody was running for the hills. So I assumed that things were not great. Whenever you see a tweet from Jim Cramer saying that Monday is going to be worse than Black Monday from 1987, we're either in for something great or something really bad. So,
Yeah.
it's for me. It was maybe this is the right way to do it, but I mostly just don't pay attention because I try to think about it as this too shall pass. I've studied history enough, I've studied stock market history enough to know that the things that we're talking about today are not brand new. And this time is not different. The things that are going on, they may be a little bit unique to our time, but the behaviors of the market and the people in the markets, it's exactly the same as it was in 1999, as in 1985 and 1929. So it's not that vastly different. So the circumstances may change, but the way we react to things is not changed at all. So I generally just don't pay much attention. I was telling some guys the other day, I basically invest on the first Tuesday of every month after Andrew's stock pick, and then I don't really pay much attention to the rest of the month, just because other than getting my blood pressure up, what's it going to serve? And so I just generally don't pay much attention. And so that's, I guess, how I try to approach it.
What are your thoughts on FDVV?
A brief look at it, it looks like it's a really great fund. It has a lot of fantastic companies in it. Apple, Microsoft, Nvidia, Procter and Gamble, ExxonMobil. Like the top 10 is pretty darn good. It has 111 companies in it. It has a very low expense ratio, 0.16, which is something I really like. And so it looks like it's a really good fund. It pays dividends, which gives you that double compounding advantage. And so it seems like it's a pretty decent fund to me. It's had 20% returns over the last 5 years. So that's nothing to sneeze at. Pretty much matches the market. I think that's great. What are your thoughts?
Yeah, like you said, there's a lot of good companies in there. The holdings turnover, I looked on Yahoo Finance, was about 14%. You think about turnover, that's how often they are selling the stocks and reinvesting them into something else. A 14% turnover implies they're holding more than 5 years, less than 10 years. So that's pretty long term. That's pretty good. So in all those metrics, I like it. Frankly, I had not seen this ETF before. I don't invest in ETFs, so I don't look at them too closely. But I was like pleasantly surprised when I saw, okay, there's Apple, Microsoft, Nvidia's in there. JP Morgan, Visa, like you said. So great collection of companies. I own some of them myself. And as far as having that as an investment versus trying to individual picks, you're trying to build that skill of stock picking. I like that. I think it's pretty cool.
Mhm.
I do think it's pretty cool. Again, as long as you're understanding that, like, that's not a panacea. It's stock market, stock market. So we've all seen how crazy it can be, as long as you're keeping all of that in mind as well.
Yeah. Yeah. I think it's a smart strategy to put some money in air quotes safer things or things that you're more comfortable with while you give yourself time to learn how to do what you want to do. And you can always adjust the portfolio allocation as you get more experience. But I think that's a great place to start.
Also, by the way, when I've talked about dollar cost averaging, a lump sum, I've never said 25 years. That's a very conservative dollar cost average. Doesn't have to be that long.
No, no, it doesn't. You can do it for however long you want. You can do it for however much you want, and you can adjust those parameters as you go along.
Yeah.
Yeah.
Like you said, like as whatever makes you comfortable enough to
Mhm.
continue going, I think is
Yeah.
most important.
Yeah.
Yeah.
I mean, the thing that always stuck with me was when people would ask Charlie or Warren, how do you sleep at night, or how do you feel about all this? And they always say we sleep like babies. It doesn't matter whether their stock is killing it or if things are not doing well. They just keep on, and they're comfortable with what they're doing. And I think if we can achieve that sort of air quote zen about our investments, that's a really good place to be.
Yeah. Yeah. They're in a good spot.
For sure. For sure.
The best stock picks require a light bulb moment. To see exactly what that looks like, check out one of my previous reports at stockwriteup.com.
All right. So the last question is quite long. So I am going to paraphrase a lot. I apologize to the person who wrote the question. He did give me permission in the question to paraphrase. So it's from Brad Rufus. He's an investor from New Zealand. And his basic question was he wants to invest in individual stocks. He has a family, he has kids, job. So time is precious. And he knows that he needs to do the work and read the 10Ks, but his question is, can he use something like AI to help either summarize 10Ks, quarterlies, things of that nature, to shorten the time that he needs to work on it? And if yes, then how can he verify numbers? Because he's concerned that numbers aren't always going to be accurate and he might miss things. And as a newer investor, he's worried he may not know that he's missing things. And if it's a no, then what kinds of things could he do to maybe help accelerate the process, or at least, up the learning curve, if you will?
Well, I'd love to hear your thoughts first, because I think you'll be gentler than me.
All right. So here's the skinny. You can't trust it to be right. You just can't. And especially for specific numbers, you can't trust it to be right. That in and of itself makes it really, 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 really hard to use at this point, at this stage. I'll qualify this by saying at this stage, it's really hard to download a PDF, upload it into whatever AI platform you like, and to have it, give you accurate output. Even worse, if you try to just connect it through the internet, you never know what you're going to get. It's like Forrest Gump says, it's like a box of chocolates. You never know what you're going to get. So in that respect, I think it can be really, really hard to utilize it. I have heard some people on some podcasts talk about, it's a platform called Notebook LLM, which they will use to upload PDFs, YouTube videos, and things like that. And you can ask that questions and it gives you links to what it's quoting. So you can go back and forth to verify, but it's still a laborious, long process. It doesn't sound like it necessarily speeds anything up. So he also mentions FinChat, which does have an AI in it. And that can be okay to ask questions about specific things. But again, you're still going to have to spend some time verifying to make sure that the numbers that it's putting together are going to be accurate. Because I have noticed, no offense, Braden, that there have been times when I've asked it questions about a quarterly report and it gives me, a revenue number. Let's say it grew 22%, you look and it actually grew 14%. Or the numbers that it's quoting are from not this year, but last year kind of thing. So it's not egregious, but still it's not as accurate as you'd like it to be. So therein lies the challenge. I would not encourage anybody to use AI for that kind of stuff. Unfortunately, I think, the best way to learn about the companies is to read the actual financial statements. And what I would probably do, honestly, is reset your expectations for yourself. So, for example, if you want to learn about, I don't know, Moody's, just pick a company, Moody's, and you want to learn about it, then reading the financial statements is going to teach you the most about the company in the most accurate way. But instead of like stressing about, I need to learn about Moody's today, give yourself 2 or 3 weeks to work through many of the financial statements as you can. So, for example, if you have a lunch break at work, bring a device that you can read it for half an hour and take notes. If you ride a bus or ride a train to work every day, do the same thing. If you drive to work, you can download the Quarter app for free, and you can listen to the quarterly earnings calls on the app for free while you drive to work and while you drive home. There are ways. Some of my friends on the internet machine, they basically don't watch. They skip an extra hour of TV a night. So instead of posting up on Netflix for 3 hours, they only do it for 2, and then the other hour they spend using to better educate themselves. So there are. I'm not saying that Brad's not utilizing these ideas, but there are ways for us to look at our life and figure out, okay, what is important to me? Family is important. Obviously, spending time with the kids is important, but this project is important to me. So instead of instead of spending time doing other things, you just choose different things to spend your time on. And that can give you a lot more time than we think we have to do the things we do. If you're unsure about this, do a time audit. Spend a week and write down, how much do I do this? How much do I do that? And then look at it at the end of the week and you're going to be surprised. Like, oh, I spent a lot of time in this. So I guess that's kind of my take. I guess my gentler take. Let's hear Sir Andrew's not so gentle take.
I love the idea of a time audit. I think that's fantastic. It's almost like, to me, reading a book summary versus reading the actual book. Like, I don't know about you guys, but when I read a book, sometimes being immersed in the book helps my mind to wander or put connections in that if I'm just reading a 5-second snippet summary, my brain's not going there. And so in the same way, that's not something AI can do or can ever do, is make your brain think deeper. And really, to me, when I think about reading financial statements, reading annual reports, that's the biggest unlock for me, is what can it make my brain think about? It's not about regurgitating information. If it was about regurgitating information, the AIs would have already taken over, and there would be Warren Bot would be the number one trader on Wall Street for the
Right.
last 3 quarters. That's not the case. It is a very complex and intellectual game that we're playing, picking stocks, and AI can just never replace that. I know there's a big push, it seems, just in society in general, of how can I leverage AI to make my life more efficient, and I love it, and I've totally gone down that rabbit hole too. But when it comes to learning businesses, thinking deeply about business models, moats, you can't automate that work. Either your brain goes into that deep learning or it doesn't.
Mhm.
So I am not big, if it's not obvious, I'm not big on AI being a big research tool for helping investors think deeply. Not to say it's useless, but just to say, in the context of, okay, I'm going to use it to save time so I don't have to read as many annual reports. I think if anything, you're cheating yourself than cheating the system by using AI to read annual reports.
Yep.
That's my aggressive opinion.
Yeah. And to further kind of clarify that thought a little bit, think about, okay, so Game of Thrones. Like anybody that read the books enjoyed the movies, but it wasn't the same because there's so much more context in the book that the movie is in essence a summary. It's a 2+ hour, 3+ hour summary of 1,500 pages. And it's impossible to capture all the detail that you pick up in George Martin's writing that you would pick up in a movie. And I mean, subtly, there can be things visually that they can illustrate that maybe shortcut some of the words that are used, but the imagery that you get from the book is going to be different than it is from the movie. And that is really, it's kind of it's the movie is a summary, whereas the book is the whole shebang. And if you see any complaints about any of the movies, the shows, it's always that they left this out, they left that out, they left this out, they left that out. And that's kind of the same idea when you're reading a 10K. Now, AI can be helpful if like you don't know what questions to ask yourself when you're reading a 10K. You can use something like that to help you give some framework like, okay, maybe I can look at this and maybe I can look at this. I've used it to help me maybe try to figure out a business model that I don't quite understand. And it can give me context that maybe I'm just not thinking about. And that can be helpful sometimes. But just by and large, like, okay, tell me about Microsoft's business model and all the risks and all the what management has to say and like so many things in the 10K. There's just no way that it's going to be able to pull it out accurately enough that you're going to get the gist of what is happening. And that, like Andrew said, that's doing yourself a disservice because you may miss something that's super important and voila, you make an investment in a company and it turns out poorly. And that's in part because you weren't educated enough on the decision. There may be something that the AI missed, like super critical, important information, i.e. that they failed a audit and that the company is going to go bankrupt because they are going to miss some payments. And you walk into buying the company with unknowing that because you relied on the AI and it missed it, then, buyer beware. And I'm not saying that's going to happen, but that certainly could happen. And if it misses that and that's what you're relying on, then that could be a problem. So that's why I would encourage you to figure out a better usage of your time as a way to manage reading the information that you need to manage. Because like Andrew said, if it was that simple, then the Warren bot would have taken over the markets several years ago. And we'd be talking about what's the next greatest movie coming out, not stocks.
Well, we can do that too.
Yeah, right.
100%. I would not be surprised if that happens sometime in the near future. It's gotta happen. There's so many people using it now. It seems that you're gonna miss things and be careful, like you said.
Yeah, be careful. I think the bottom line is, remember, it's a tool to help you and it's a tool to help you get better, but it doesn't mean that it replaces the effort that we need to put in to make investments that we need to make in. And it's not a shortcut and it's not a panacea. It may be 10 years from now and maybe 20 years from now. Heck, it could be here 7 years from now. I don't know. But as it is today, no.
Yeah, for sure.
All right. So with that, we will go ahead and wrap up our show for today. I wanted to thank everybody for taking the time to send us those fantastic questions. We hope we helped answer your questions. If you have any questions, please don't hesitate to reach out to us. We're here to help. You can send them to newsletter@einvestingforbeginners.com. You can also post them on the Spotify app, and you can also send them to us on the socials, either X or LinkedIn. And so with that, we will go ahead and sign us off. You guys go out there and invest with the margin of safety. Emphasis on the safety. Have a great week, and we'll talk to y'all next week.